Hello everyone and welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, it has been quite a busy day in the markets once again. As I mentioned in my morning piece this morning, I do think there is a keen focus still on tomorrow's jobs report. I think that's what we've really been building up to all week, even though yesterday and today we have had a lot of economic data which has padded out the day. The focus really is on tomorrow, just simply because that is going to be the key event which is going to have such a big influence on the Fed's decision on whether to raise interest rates at the next policy meeting in just under 3 weeks' time. Like I say, we've had plenty of data today to focus on, and there's been some good, some bad, and some which hasn't really changed views at all. This is the problem with revised data, is sometimes you can have these big revisions which can have a big impact on the markets, but more often than not with the revised data, what actually happens is any revisions are very minor, if at all, so the reaction will be quite small. Firstly, just to touch on the moves in the market, the key move that we've had today has been in two areas. One has been the pound, and that relates to the data which we've had out, so I'll come back to that in a second. The other is in Brent and WTI crude, which are down more than 2% again, so we've seen 2 days now where we've had quite significant declines in oil prices, trading back at another support level where it seems to have found some stability today finally, but like I say, quite significant falls. Brent crude down just above $45 a barrel, WTI down around 43.5. I think we may see some support at these levels, but I wouldn't be surprised in the coming sessions if we do see some further downside in both of these. I think this whole speculation that we could see a oil price freeze by OPEC members at the meeting this month on the sides of the International Energy Forum this month, I do think they were potentially overplayed. I think any possibility of a deal is quite slim, and even any production freeze will make very little difference. And I think this was just very overplayed at the time, and I think now that the markets are really adjusting to the fact, to that very fact. The other move, like I say, is in the pounds, and I'm going to take you to the economic calendar now, so we can take a look at the data and go into a little bit more detail regarding it. We had some data from Asia overnight, the manufacturing and services PMI data from China, manufacturing data from Japan. No real surprise from Japan, still in contraction territory. No real surprise given the fact that the strength of the yen is making it very difficult for Japanese manufacturers on the exporting side of things. In China, the data was very mixed. The Caixin number, which covers small to medium-sized enterprises, private firms predominantly, showed that there's stagnation in the sector, dropping from 50.6 to 50, but then the official reading rose from 49.9 to 50.4, so a bit of a mixed result here. I don't really know if we can take too much from these numbers. The non-manufacturing PMI, which covers, of course, the services sector, which has become the biggest sector now for Chinese growth, fell from 53.9 to 53.5, but again, this is still a strong growth reading even if we have slipped from those higher levels. The manufacturing PMIs from the Euro area this morning, we did see some slippages in the likes of Italy and France. The overall reading falling from 51.8 to 51.7, so really the impact from that was quite small. The key one was the UK. Now, we had the first figure which came out from the UK in July, that fell to 48.3, a big fall in the number following the Brexit vote. Of course, that was the first month following the Brexit vote, and I think markets were building themselves up for a slight improvement, because you tend to get the initial knee-jerk reaction followed by the real reaction from the markets. And I think people expected the real reaction to the vote to still be quite depressing, I guess. But instead we saw this massive rebound to 53.3. Huge difference compared to what markets were expecting. It was the biggest month-on-month, the joint biggest month-on-month improvement on record in the 25 years that this data has been collected. A hugely significant move that really propelled the pound higher in early trade. It's now trading higher by 1.25% against the dollar. Is trading up 1% against the yen, and up just under 1% against the euro. So we're seeing some big moves off the back of this in the pound, and I do think that's weighing on the FTSE today, which is the worst performing indice in Europe so far. In the same way that when we saw the weakness in the pound, it was actually helping to support the FTSE. I think there's two things that really drove the improvement in the manufacturing PMI. And I guess this is where we start to see the win-win situation in the early stages of Brexit, which I don't think people were really factoring in. One is the fact that it's too early in the process for consumers to be heavily impacted. While businesses aren't necessarily investing as much as they may have otherwise done, they're not laying people off either, and the impact that it may have on, it's likely to have on wages going forward because of higher import costs and potentially slower economic growth. This isn't necessarily impacting the consumer yet, and what we've seen is from the retail sales, BRC data, etc., is that consumer spending has remained strong in the UK since the vote, and this reflected the fact that domestic demand was still was actually getting stronger. The biggest impact was from abroad. The 10% decline in the pound, or the more than 10% decline in the pound, has led to a surge of orders for UK manufactured goods abroad, and the combination of this has been hugely beneficial, it would appear, for the manufacturing sector, which only a month earlier was quite concerned about the outlook. Now, when I say this, I do think this is going to be relatively short term. While the demand from abroad may continue to be higher with the weaker pound, domestic demand I do expect to ease off once we do start to see businesses investing less, wages maybe start to stagnate a little bit. If we do see unemployment, for example, tick high, if we do see a recession in the UK, or at least a contraction, again, that's going to affect consumer sentiment as well. So I think what we've got, this is early win-win situation. I don't expect this to continue for the next year, for example. So great number, much better than we were expecting, but not something we can necessarily build too much hopes on. It is, though, quite good that we are seeing the benefits from export orders, so that is the big win in my view from this data. The other data that we've had today has come from the US. Again, the focus for this week for the US is on tomorrow's jobs report, so this data today was only ever likely to have limited impact. The biggest disappointment, I guess, from the number came from the ISM manufacturing PMI, which fell to 49.4 from 52.6. A big decline in this number, but it is just one number, so I don't think there's anything to be hugely concerned about. For one, the manufacturing sector still makes up a small part of the US economy, so it's unlikely to be a massive drag. We did see an impact in new orders falling from 56.9 to 49.1. That's the new orders component of the ISM number. And employment actually fell from 49.4 to 48.3. So it was quite a very disappointing number overall, but like I say, it's just one number. If we continue to see this form of pattern in the next few months, then maybe there's something to be a little bit more concerned about, especially following a weak first half of the year in terms of growth. I don't think a number like this is going to have any impact on whether the Fed raises interest rates in September or not. I do think tomorrow is going to be have a far bigger impact. That and wages. Wage growth is likely to be the thing which really contributes to higher spending, and which could lead to higher economic growth down the road, which is likely to help support the economy effectively, and likely to spur inflation, which is what one of the Fed's two key mandates. And what we saw here was unit labour costs actually rose 4.3%, up from 2% previously. That's a huge jump in unit labour costs, and this takes into consideration the fact that productivity actually fell by 0.6%. So productivity, the way the unit labour cost is calculated, takes into consideration two things. It's hourly earnings and productivity, and productivity actually comes off the number in order. So had we seen positive productivity, then that would have actually reduced the unit labour cost. Instead, we've seen 3.7% gain in hourly earnings, and then you got the 0.6% decline in productivity, which led to the number of 4.3% for the unit labour costs. The important point of this, I should stress, is the fact that hourly earnings have actually risen 3.7%. That's a very significant piece of information, especially when you consider that personal income and personal spending, as we saw last week, were rising, and the fact that average hourly earnings, which we'll get the latest number for tomorrow, has been rising over the last 18 months and is already reaching quite high levels. I think it's around 2.6% year on year, and when you take into consideration this number, that would suggest that this is going to keep rising, and with it you'd expect inflation to keep rising too, which will hopefully, like I say, spur on more economic growth in the US, which the Fed again is going to be taken into consideration when it's deciding when is the right time and what the right pace for future rate hikes actually is. But like I say, again, a lot of economic data today. We've got some great insight from the UK, some useful insight from the US, but the key thing that people are really focused on is still going to be the US jobs report tomorrow. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.